All right. Welcome back to class. So this is investment appraisal, right? And this is our second class on investment appraisal. Okay. This topic is very broad that sometimes it's difficult to finish easily. Okay, it's difficult to finish. So we'll just try our best to solve as many questions as possible. All right. So if you were in my part 1 of the class, you will realize that we have done a lot of things. Have you? We have done a lot of things. Now, before we solve any question, there were some things in my part 1 I said I'm going to address. So those are, number 1, taxation. Taxation. Okay. Number 2 is what? Inflation. Number 3 is what? Working capital. Okay. So working capital, right? Okay. Now let's talk about them very quickly. Let's talk about them very quickly before we solve this Okpayemi. It's in your past question anyways. It's an SFM question from SFM I brought it there. So let's talk about taxation first. Taxation. So you will see an investment appraisal question that has taxation in it. What are the things that you need to know about taxation? So first and foremost, number 1 is that taxation is what? It's a compulsory levy, isn't it? That every organization, Abi, should pay. Makes sense, Abi? Secondly, you can be told that taxes are charged in arrears. In arrears simply means that the tax for 2020 will be taxed in what? 2021, and 2021 will be taxed in 2022 and going forward. Then the next about taxation is that you can also be told that 50% of the taxes are to be paid this year, while the next portion will be paid what? Next year. So do 50% this year and do what? Next year, the other 50%. Then the last part, which is very, very important, is that taxes are charged on profit, not cash flow. Okay? Taxes are charged on profit and not cash flow. I've already told you the difference between cash flow and profit, isn't it? Where I said the difference between cash flow and profit is what? Non-cash transaction, which means what? Depreciation, Abi, notional cost, and the likes. Makes sense, Abi? That is all about taxation. So please take note of that. Checked. The next one is what? Is inflation. Inflation is the persistent rise in the price of goods and services. What it means is that the value of money is what? Is dropping. Abi? Okay, that's good. Now, under inflation, we have 2 types of inflation. What are they? We have specific inflation and we have what? General inflation. So we have specific and we have what? General. Now, what are specific inflation? Specific inflation are inflation rates that affect a particular variable in your question. It therefore means that the question can state that sales should increase by 5%. Only sales, so, or admin expenses should increase by 3%, or fixed costs should change by 2%. Those are specific inflation because they affect individual variables in your question. Now, what about general inflation? What about general inflation? Now, general inflation are inflation that affects every item in your what? Question. It affects sales, it affects variable costs, it affects fixed costs, it affects anything. That is what we mean by general inflation. It is one inflation rate applicable to all variables in the question. While specific inflation are what? Different inflation rates applicable to what? Different variables in the question. Does that make sense? Understanding inflation, you must understand what we call money, cash flow, and what? Real cash flow. So let's start with real cash flow. So real cash flow simply means, cash flow means money that comes in or out. I mean, movement of cash. Now, real cash flow simply means money that has not yet been affected by inflation. Okay? Money that has not yet been affected by what? Inflation. Does that make sense? So the cost of an iPhone today may be 1.9 million, but next year it can be 2.2 million. What has happened? Inflation has set in, Abi. So that's 1.9 million, which is today's value that has not yet been affected by inflation. It's known as what? Real cash flow. Why the 2.2, as the case may be, is what? Money cash flow. Does that make sense? Now, we also have what we call money cost of capital, and we have what we call money real cost of capital. Money cost of capital and real cost of capital. Money cost of capital and real cost of capital. As you can see, I put them in front of each other. Money cash flow, money cost of capital. Abi? Real cash flow, real cost of capital. Now, what does this mean? What does this mean? You know, your cost of capital is your discount rate. Do you agree with me? Do you agree with me? Your cost of capital is your discount rate. So when you have a discount rate that does not have inflation inside that rate, what do we call it? Real cost of capital. It is a discount rate that does not incorporate inflation inside of it. That's your real cost of capital. Why? Your money cost of capital is the opposite. This is the discount rate that has what? Inflation incorporated into it. Abi? So lend me 100 million naira today, and you told me that you'll be collecting 10% every year. Let's assume that by next year, inflation in Nigeria rose to about 35%. Will you still collect 10% on your money? What has happened? You can now start demanding for how many percent? 15%. Just like a landlord now, the way they have increased their rent now. Abi? So that 10% you were demanding from me before is known as what? Real cost of capital. There's no inflation in it. Why? The one that inflation has entered into that is not like, 15% is now what? Money cost of capital. Does that make sense? Does it make sense? One is cash flow, one is cost of capital. Cost of capital is in percentage, cash flow is in money. Makes sense, Abi? So please note that golden rule, rule number one, your money cash flow must be discounted using your money cost of capital. Your money cash flow must be discounted using your what? Your money cost of capital. While your real cash flow must be discounted using your real cost of capital. That is the way you go about it. Am I too fast? Money cash flow is discounted using your money cost of capital. Real cash flow is discounted using your real cost of capital. That is the golden rule. Real cost of capital. Look at my screen, it's there already. Does that make sense? Ask your question. Yes. Exactly. So real cash flow, no inflation. Money cash flow, inflation. Any question? Stop. Any question? All right. If there's no question, the question that you need to ask me now, what it should be in your mind now, is how do you know if your question was given to you by ICAN in money cash flow? And how do you know if it was given to you in what? In real cash flow? Because maybe we must be able to identify that. Have you? All right. When ICAN begins to use the word today value, today, now, current, it means real. You were talking with her when I was saying something. When ICAN begins to use the word today, now, current, what does that mean? They are referring to real cash flow or real cost of capital. Any question? So when they say money, when they say today, Abi, now, current, they're talking about what? Real cost of capital. When they say future, tomorrow, are we there? They're talking about what? Money cost of capital. They may even call it money terms and they can call it real terms. It's the same thing. Are we good now? So ICAN can give you a question and the figures that ICAN gave to you there, they are all on in what? In real cash flow. Am I making sense? But the discount rate that ICAN will give to you is the money cash flow. I repeat, ICAN gives you a question, all the figures there are in what? Real cash flow, today figure. But the rate that they want you to use to discount is in what? Future figure, money figure. What will you do? Convert your rates, which is in money, down to what? Real. Or you convert all the real cash flow, abi, real money, down to what? Money cash flow. It must rhyme. Both your cash flow and your rate must be either real altogether or what? Money altogether. Am I making sense? Am I making sense? So whenever ICAN gives you the opposite of each other, just convert. So if you have your real cash flow and you want to convert to money cash flow, you have to apply what? Inflation rates. Abi? So let's say today your sales was 10,000 naira. And they say tomorrow, which is year one, Abi, they say the sales should go up by what? 5%. That is inflated by 5%. What will you do? 10,000, Abi, times what? It should go up by 5%. What will it be? 105%. And this will say times 105 divided by 100. Isn't it? Isn't it? So that one, the answer that you get will now become your what? Money cash flow. Are we together? So when you are giving a real cash flow, use your inflation to increase it to get your what? Your money cash flow. Does that make sense? Then what about you are giving a real cost of capital and you want to get your money cost of capital? Or you are giving your money cost of capital and you want to get your real cost of capital, what do? You also have to convert. So if you have your real cost of capital, you can convert to what? Money cost of capital. Or if you have your money cost of capital and you need your real cost of capital, you can also convert to what? Real cost of capital. For you to do that, you need a formula. That formula is known as the Fisher's equation. Your Fisher's equation is equals to 1 plus m is equals to 1 plus r into bracket 1 plus what? I. Any question? One plus m is equals to 1 plus r times 1 plus I. Your m is your money rate. Your r is your real rate. Your m is your money rate. Your r is your real rate. Your I is your interest and inflation rate. Your I is your inflation rate. Are you with me? So if you want to convert money to real, it's the same formula. If you want to convert real to money, it's what? The same formula. You can just change your subject formula. For example, if you want to get to money cost of capital, you just say equals to what? 1 plus R, Abi, close bracket, 1 plus what? I, Abi, minus 1. This plus 1 here will go to what? Minus 1. You know, in front of this one, there's an invisible plus. That comes here as minus 1. When we start solving, you'll see, I don't want to bombard you with formulas. There's not really any big deal in the formula. So if you're looking for real rates, money rate will be given to you, Abi. If you're looking for money rate, real rate will be given to you. So just slot it to the formula and you get your rate. Am I making sense now? All right. The next thing I want you to understand is that by default, and this is a golden rule, by default, your question is usually in money. Money cash flow and money rates. That is by default. Except otherwise stated, except what ICAN says that, oh, this one is in real low. But all things being equal, the figures given to you in your question are all money cash flow. The rate given to you in your question are all what? money rate, except otherwise stated. Any question on that? Any question on that? Any question on that, under inflation? All right, the next thing I want you to understand is that in this Fisher's formula, this I, which is inflation, is usually your general inflation, not your specific inflation. No. You know, we have two types of inflation, specific and general. So the inflation you are using in your Fisher's formula is your what? General inflation. Talk to me. Any question? Online student, talk to me. It's always general inflation. Your I is your inflation. I like that. All right. What's the next thing that we're going to talk about? Working capital. Okay, please note that inflation, please, this is very important. Okay. Taxation. Taxation is an outflow of cash. Don't forget. Okay? Taxation will lead to what? Outflow of money. Yes or no? You are paying money now. Now. Another thing you should know about taxation is that taxation can extend the life of your project by 1. So if the project is 4 years and you are paying tax in arrears, what happens? The project expands into the 5th year. Abi? Now. We did it in that last question. Let's talk about working capital. Working capital. Lecturer, are you with us? You're looking morose. Life is easy. Take it easy. Take it easy. All right, so working capital. Working capital is the funds that you use to finance your business. Abi? Those extra money you give to your business to keep your business up and running, to pay salaries, buy fuel, you know, pay for logistics. They are all known as what? Working capital. All right, 2 things involved. Working capital can be incurred once or can be incurred what? More than once, Abi, repetitively. It can either be once or what you call one-off, or it can be repetitive. When I mean one-off, I mean that if a project can last for 5 years, maybe you can just incur working capital in year 1 only, in year 2 only, maybe year 3 only, but at least it is once. Abi? Good. Share not repetitive. You incur working capital like every year, all through the life of the project. And I think it's common, because if you spend money to do a project, you have to spend money to service that project. So I think it's common. Okay. So you see repetitive what? Working capital. Working capital is both an inflow and an outflow. So working capital is both an outflow and an inflow. Okay? I'll explain. How can something be inflow and outflow at the same time? It's not really at the same time. Working capital is an inflow when we are releasing that working capital. When we are taking out the money to do or to run the business, it's an outflow. Yes or no? Now, you want to pay salary, you need what money? That's an outflow, now you pay. You want to buy for, you need money, you go and collect money. That's an outflow, now you pay. Working capital is an outflow at the point where you are what? Releasing that working capital for what? To cushion for that expenditure. The rule in investment appraisal is that working capital must be recouped at the end of the year. In case you are solving question and you see that ICAN is recouping it, it's an hidden. They don't need to tell you the question. It's an hidden, rule. Working capital must be recouped means that working capital must be gotten back as at the end of the investment life. That's the hidden rule. I'll give you an example. If I give my business 100,000 naira, Abi, in year 1, The assumption is that as at the end of year one, the business should give me back that 100,000 naira. That is the assumption. And I'll tell you why the assumption is like that. The assumption is like that because working capital is seen as a loan by the company to the investment. So let's take an example. This is the company. This is the investment. We have already given this investment 20 million naira to run. But this investment is saying that, listen, oh, you can also be helping me with some money every year. Are you getting it now? To cushion for some kind of what expenditure. The business says, no wahala, we are up to the task. So the business gives this investment money every year to run. That money is seen as a loan. So interpret working capital like a loan given by the company to the investment to cushion for its day-to-day activities. Is it right? Does it make sense? Makes sense, Abi. So the business is saying that, the investment is saying that in year one, my business, the investment is going to last for 4 years. Let's take an example. The investment is saying that, please give me 50 million in year one. In year two, up your game to 70 million. In year three, please, sir, give me 90 million. In year four, give me what? 120 million. This is what we need. Then the company says, no big deal. We can finance this. We can look into this. But look at what the company is going to say. The company is going to say, okay, this is year zero. The company is going to say, no problem. We'll give you that 50 million in year zero. Am I making sense now? We'll give you that 70 million in year one. But we are not giving you 70 million. What are we giving to you? 20 million. Let me explain. I give you 50 million to run your business, Abi. In year two, you are not telling me that I should give you 70 million. Okay, have you paid me my 50 million? You have not paid me, Abi. So I'm only going to give you 20 million. That's your business. So what we do in working capital is that we are looking at the incremental working capital. That is what we are financing. So if I give you 50 million in year zero, so you can use it in year one, and you are asking me for 70 million in year two, I get it. Now what I'm going to do is to give you what? 20 million. So I will give you the money in year one, so you can use it in what? In year two. You know, we pay ahead. Understand? Then, how much have I given to you now like this? Good. Now, you want 90 million, Abi? Yeah, sorry, you want 70 million, Abi? Abi? So what will I do? Okay, I'm giving you 20 million. Now, 70, you want 90 million. Now, what will I do? I will add 20 million. Because I've given you a total of 70 million before. So with this 20, how much have I given to you now? Which is this 30 million that you wanted? Now you want to add 20 million, Abi? What will I do? I'll give you how much? 30 million. So add it together. What do we have? At the end of the year, which is at the end of the useful life of the project, what do we do? All these figures are in brackets. They are negative because I am giving to you. As at the end of the year, what is going to happen is that I'm going to get back my own one. Okay, project don't finish now. Give me my money. I'm going to give you 20 million and still give you 120 million again as working capital. Pay back. You have to be a responsible project. So that's why we said that working capital is both an outflow and what? That's what is happening here. So this is on the assumption that we have working capital that is repetitive and that we have working capital that is increasing over time. Sometimes it can be decreasing, doesn't mean that it must be increasing. Abi? So from 50 to 70, from 70 it can come back to 60. From 60 it can go up again. We'll text questions as time proceeds and we'll see what we can do. Okay, but please note that all working capital must be recovered when? At the end of the project life. Am I making sense now? Are we good? All right, I think that's all. Is there anything about working capital? That's all. Okay, next thing, working capital is not taxable. We don't tax it. It's not affected by tax. By interest. We don't need interest in capital budgeting. Interest payment is not needed because your cost of capital will take care of it. So working capital does not really have an effect in your calculation. I think that makes sense. Now, what we have done, we are good to solve questions. It's unfortunate that your last diet, they tested the boss, and that boss was actually relevant costing in investment appraisal. We'll look at that as we proceed. They may not bring it back because they tested it last diet. So if they want to test another one, they will change pattern. But just have to know it. All right. So this is what we're looking at for today's class. So let's cite a question. This question is actually May 2022. Question 3, SFM. It's in your FM past question. Yes, it is. Okpeyemi, just go to discounted cash flow in your list. In that discounted cash flow, you open it small, be taking the question one after the other. You will see it. So question 3, May 2020 what? 2. And that is who? Okpeyemi. Okay, so let's see. Now, what did they want us to do in this question? Yeah, calculate the net present value, which is NPV of the above investment appraiser. That's a good mark. 14. A good mark. 14. How many years is this project? It's looking like 3 years. Abi? Just look my screen. Doesn't matter. It doesn't matter. Okay, so let's read the question. Okpeyemi operates in an economy that has almost zero inflation. Abi? Management ignores inflation when evaluating investment projects. What this tells me is that there will be nothing like inflation in this question. You say the economy has like zero inflation. It's very insignificant. So then I said that, okay, that's because it is very low. So they ignore inflation in evaluating investment project because it's very low and considered what? Insignificant. They now went further to say that Okpeyemi is evaluating a number of similar alternative investments. The company uses an after-tax cost of capital of what? 6%. Definitely that's what we're going to use. Your after-tax cost of capital of 6%. That's what we're going to use to evaluate the project. Do you understand? Now, they now said the company uses an after-tax cost of capital and has already completed the evaluation of 2 investments. The third investment is a new product that would be produced on a what? Just-in-time basis. You know what that means? You know what that means, right? You read that in your notes? Interesting. And it's expected to have a life of how many years? 3 years. Now, this investment requires an immediate cash outflow. How much? So we're going to be investing 200,000. So that is going to be our outlay. B, which does not qualify for tax depreciation. Now, they said that we are going to invest 200,000 to buy 2 for our investment. Please, that investment is like you are buying a machine. You can put it like that. It's not shares, it's machine. Okay, like a plant. And they are not telling you that which does not qualify for tax depreciation. It simply means that the investment would not be depreciated. There's no capital allowance on that investment. That's what it means technically. There's no what? Capital allowance on that what? Investment. The investment does not qualify for tax what? Depreciation. Does that make sense now? So forget anything about tax depreciation. They said the expected residual value at the end of the project life is how much? 50,000 naira. It means as at the end of the project life, that asset that we bought for 200,000 will actually be how much now? 50,000. Abi? A draft financial statement showing the values that are specific to this investment for the 3 years is as follows. They are giving us a draft financial statement. Now, what's the draft financial statement? They gave us for year 1, year 2, year 3. And they said what? Sales, which is an inflow, Abi. Sales will be an inflow, Abi. An inflow, it brings money to the organization. So they gave you sales and they gave you production costs. This one that is asterisk, it means that there's something that need to talk about it. Okay, that's why they did it here. So they gave you production costs. So these production costs are basically what? Outflow. Do you agree with me? Okay. Now they gave you profit. So your profit is actually your sales minus your production cost. Can you confirm that? Just 1 year for me. Your production cost. That's the profit there. You can confirm that. Let's be on the same page. Press calculator. No, me. Thank you. So if that is correct, it means this 230,000 minus all these things here. Huh? Why are you confused? Okay. Then this question would have been too much easy, or would have been very easy if there was no receivables and payables. So what makes this question tricky is the receivable and payables and nothing else. This is a normal question, a small question. So they gave us receivables and payables. Now, receivables will affect sales, Abby. Payables will affect what? Production cost. So we have to do adjustments for that. But are you with me now? Then I said, note that other production costs shown above include depreciation calculated using the straight line method. So inside this order, we have depreciation inside this amount. So we have to take out depreciation. We have to do what? Take out depreciation. The reason we are taking out depreciation is because we needed cash flow. And you know, cash flow is without what? Depreciation. Does that make sense? No. Do you agree with me? Cash flow is without depreciation. But since I've included depreciation, then what they got there is profit. We cannot work with profit. Okay, we can't be working with this profit. So we are working with cash flow, so we have to take out what? Depreciation. Secondly, the question stated that capital allowances are what? Ignored, Abby. Where did I see that one? Okay, they mentioned something related to capital allowance around here. Yes, here's the part. This investment requires immediate cash outlays and does not qualify for tax depreciation. Okay, so it does not qualify for capital allowance. All right, so basically the main reason we are taking out depreciation is because we needed our cash flow. That's the main reason. So they now said the company is liable to pay corporation tax at 30% of its profits. Taxes are paid on profit. I gave you that as a point, not on cash flow. So you're going to be paying your corporation tax on your what? Profits. 1/2 of this is payable in the same year as the profit is earned, and the remainder is payable in what? So half of it will be payable that same year that you earn your profit. So if you make 5 million in 2020, you pay 2.5 that same year, and pay the other 2.5 what in 2021. Does that make sense? It's clear, Abby? Good. Are you people hungry? Even if guys are not hungry, Alima will be very hungry. She has eaten. She eats per second billing. She eats on a frequent, so she's not tired. So that is all about this question. So they say we'll calculate the NPV of the above investment proposal. Does that make sense? Now let's calculate our NPV on this project. So let's calculate our NPV. How many years is this project? 3 years, Abby. But it's going to extend to 4 years. Why? Because of tax, Abby. Okay, good. So I'm going to say year 1, year 2, year 3, and what? Year 4. Abby? Are you confused? Oh, okay, 0. No, we can do anyone. No. Do you think? Yes, now. Okay, the one that does not have 0. That's what you understand. What do you mean by 0 to 1? 0 to 2? We cannot do it like that. Oh. That one is annuity. Are we working on with annuity? So I thought what you were even asking is that we did not start from year 0. So from year 0, we have year 1, year 2, year 3, and year 4. Let me get more space. I can try not to even start from year 0. I will just start from year 1. I will still do it and get my answer. Year 1, year 2, year 3, and year 4. Are we good? How many years is it? And 0 is not part of the project now. 0 is the year of investment. These people, just pay attention. Let's solve. Let's solve. What will be the first thing I'm going to include in this solution? Who can tell me? Initial outlay. Must I put initial outlay first? I can start with sales, Abi. I can start with sales. I can start with outlay. Doesn't matter. So I want to be flexible. So let's say, yes, it's not a must. Do we have resale value in this question? So I can say outlay slash what? Scrap. What's my outlay? Go name 200,000. Positive or negative? How will it be? Did I fall? Thank you. What about the residual value? 50,000. So residual value is 50,000. So residual value simply means that at the end of the project, Abi, you what? You get back that money. So that's what's the end of the project? 2 years, 50,000. That will be positive. Okay. You can separate it. You can say outlay here and put scrap value down here. It doesn't matter. So there is no IFRS or one standard that is guiding this thing. Makes sense, Abi? Okay, so after that, the next thing that comes to my mind is what? Sales. What's my sales? Nothing in year 0, Abi. 230, Abi. What's the other one? 272. Then nothing in year 4, Abi. Now, I told you that your sales will be affected by receivables. You know, receivables are those people that have not paid you. And you know, if they have not paid you, the money is already inside sales, but they have not paid you, Abi. It means that a cash flow has not yet occurred. So we have to adjust for that portion that has not yet occurred. So what we are going to say is to say receivable, Abi, closing. And receivable, opening. If you like, put opening first and put closing next. It's none of anybody's business. So these are our closing receivables, ba? 20, 30, 25. Let's go. Don't worry now. Fokare Bale, 20. You're not even supposed to be asking me that question. Where is opening? As an accounting student, you're asking lecturer, where is opening? So for this closing, for this opening receivables, what are we going to do? The closing of year 1, Abi, will be opening in year 2. Does it make sense now? The closing of year 2 will be what? Opening in year 3. The closing of year 2 will be what? Opening in year 4. So as you can see now, it's not only tax that is making this thing to extend now. Are you seeing it now? The receivables has affected it. Okay, so we'll put our closing in brackets because they have not yet paid for it. That's our closing receivables. People that at the end of the year they've not paid us, so we'll take it out. So that is the only thing that will affect our sales, the receivable part of it, and that is off our income. So give me figures, give me figures, give me figures, give me figures, give me figures. 25. This one is 210. This one remains 200. You see the problem I have with ICAN students? Punch calculator, no. Are you conductor that is using it to do mathematics for change? 270. The way you do anything, that's the way you do everything. If you are inside the examination hall, you use your brain and you do nonsense there. When you come out, you not tell me, I scatter it. You scatter it with wrong figure. You will not kill me. You have to work in the alignment of that well before you say it is well. They play. You have carried all your problem and give to him. Gave you wisdom, created you in this image. Everything is God now that you. Even the angels are tired. They say that they cannot talk. God, let me bring that remote, please. I want to use it. All right, so that's fine. So this will be total, Abi. Total, like total income, Abi. Let's just say A. Let's call it A. So if it's our total income, that's fine. Okay. Let's look at the next part, which is what? Production cost, Abi. Production costs. Let's do a working for that. Let's do a working for that. Work it. The reason why I'm doing working for production cost is because you know production cost is made up of material, labor, and order. And that order has depreciation. So we have to take out that depreciation. Do you understand? So for year one, production cost 1, 2, and what? 3. So how much is production cost for year one? We have material. I mean, material, what again? Labor, and what again? Order. So how much is material? 54,000. 102,000. 66,000. 60,000, Abi. 80. What again? 70. For this order, we have a challenge. So let's do a working for order. For order. For year one, year two, and year three. Now, for this order, how much is the order? Actual figure. Actual. For order 80, 90, and 80, Abi. So there was one additional function that said, other production costs shown above include what? Depreciation, calculated using the what? Straight line method. For tax purpose, we don't use straight line method. We use capital allowance. Abi, you know, for tax purpose, all those your straight line method does not work here. It's capital allowance that we use. So we have to do what? Take out your depreciation. Abi, what's your depreciation? Our depreciation will be what? Depreciation is equals to what? Straight line method, Abi. Costs minus scrap value all over expected useful life. What's the cost of the investment? It's not me and you. What's the scrap value? 50,000. How many years? So what do we have? 50,000. So it's 50,000. So this is 50. This is 50. And this is 50. So take it out. This is 30. This is 40. So are we good? Are we good to this space? So it therefore means that our order cost is now our order cost. 30, 40, 30, I mean. So take it there. 30, 40, and 30. Oh yeah, total me. The first one is 144. Second one. $166. That makes sense, Abi. So let's take it up. 144, 222, 166. So 144 for year one, Abi. 222, 166,000. So nothing is here. I think nothing is here, Abi. So this is your production cost that we have talked about. It's going to be affected by payables, Abi. So let's put our payables. So I'll just say PAY, closing, and then PAY, opening, dash, and what? Dash. So what's our closing already given to us here? We have 6,000 in bracket, Abi. We have 9,000 in brackets, and we have what? 8,000 in brackets. Okay, so 6,000 closing will become opening here. There's 9,000, and yes, 8,000. Ladies and gentlemen, I'm glad to tell you that you can now give me figures. Give me figure from production cost. 100 and what? 38,000. The next one is what? The second one, 219. How are you getting 138? You're only doing from production cost down. Forget about total here. What about this one? All these figures are correct. So here should be dash. Oh, yeah, go on, go on. This last one is 8,000. This last one here, 167. Please confirm, is that correct? So total, let's call it B. So the A represents our total income, the B represents like our total expenditure. So let's get our net cash flow. Do A minus B. Net cash flow before tax, Abi? Before tax. So just say A minus B. So what's A minus B? Minus, it's not possible. 210 minus 138. What do you get? The other one, 340, 72. Okay. The next one, 121,000. 108. And she's still saying yes now. Yeah, give me this one. 17,000. Thank you. That's our net cash flow before tax. Now let's apply our tax, Abi. What did I tell you that we do when we're calculating tax? You apply it on what? Profit. Good. So let's come down and calculate our tax. So tax. So year one, Abi. Year two, year three, year four. Abi?
Sorry, sir. Hello, sir.
Yes, go ahead, please.
Yeah, that place where we had our opening payables, I realized that when we were solving, we added our opening payables to the cost. But you know that for year 4, that opening payables is 8,000. Are we supposed to deduct it from the cost? I mean, are we supposed to deduct it from the total A?
Yes, you're supposed to deduct it. Because everything you do here, the final answer is supposed to be minus. It's a cost, production cost. Production cost. So this 8,000 you are seeing here, you still say 25,000 minus 8,000, this 8,000 down to get the 17.
Okay, sir. Thank you.
All right, so let's get our tax. So I said tax is paid on what? On profit, okay? So what I would do here is year 1, year 2, year 3, Abi. What's our sales? What's our sales figure? 230, 350, and 270. What's your production costs? We've done it here. 144, 222, 166. 144, 222, 166. Oh yeah, net. Minus it. 86, the first one. So 104,000. So when we're calculating our tax, okay, this is going to be the amount we're going to calculate our tax on. So we don't need to factor in those receivables and payables. Whether you sold, you will not be telling tax authority that they are still owing me. Your tax will be calculated on your total sales. That's why we are doing our total sales and our total production cost here. So we are not using receivables and payables to amend anything. Right, Master, you are in? All right, so these are taxable income or taxable profits. So let's apply our tax at 30%. 25,800. Next. $38. All right, so that is our tax, Abi. But don't forget 50% now. And 50% next year. That's 1/2. What's 50% of 25,800? $12,900. Then the other half will be paid in year 2, Abi. Then what about 50% of 38,400? Yes, no. 8, 19,2. Okay. The other half will be here. Run it for year 3. Then the other half will be here. So let's get our total tax. Just add these ones for me. This year, 32,100, 15,6, 12,9, 34,800. Any question, please? Any question, please? Any question, please? That is our tax. No question? All right. So, yes, go ahead. You want to ask a question on payables? When we are in tax, let's put our tax first. 12,9, 32,1. So here's our tax going to be. That's this tax, I mean. So what is our tax? 12,9 under year 1, 32,1 under year 2. So let's go. Dash 12,9. 32,1. Okay. 34,8 and 15,6. 34,8, 15,6. In bracket, have you? Because it's tax. The first one. So the first one is 200,000, yeah. 59,100. Okay. 88,900. Next. 73,200. Next. Your net cash flow before tax minus tax. Okay. Your net cash flow before tax, which is this 72 minus this, 121 minus this 32,1, 108 minus 34,8. That's what we are doing. So this is now our what? Net cash flow, Abi, after. Once you have gotten to after tax, your work is done. You now move to your discount factor, Abi. So before we go to discount factor, let's take a question. Yes, what's your question on the payables? What's your question on the payables? Somebody has a question. Exactly. I don't understand what you mean by I didn't subtract it in the payables. 6,000 is the closing. It became opening year. 9,000 is the what? Closing became opening year. 8,000 is the closing became opening year. I am only bracketing the closing. The opening are not bracketed. You get it? Ask me your question clearly if you know you are not clear. There are different things now. Receivable is to sales, payable is to purchases now. I am bracketing the closing because they have not yet paid. We are removing the closing payables from your total production. I bought goods from you worth 2 million. I've only paid 1.5 million. The 500,000 have I paid? I'm removing the 500,000 because your NPV only focuses on what? Cash flow. I've not paid. Is there a cash flow in something I've not paid for? Are you getting it now? I'm only focusing on cash flow. So for the one that I put receivable bracket, there's no mean that payables I will not bracket it. They are not related now. They are two different things. Am I making sense now? Any other question? All right. If there's no other question, please, what's our discount factor? How many percent? Based on the question, what's our discount factor? 6%. I think I saw it here. 6%. So in the first year, which is year 0 to be what? 1, Abi. So please do the rest for me. The formula is 1 over 1 plus r root a square n. Give me figures. It's 6%. Put it in this formula. What do you have? 6% year 1, 6% year 2, 6% year 3, 6% year 4. Zero 0.942. You see that there's nobody online that can press calculator. Zero 0.890. Next one. Zero 839. The next one is what? Zero 0.79. So help me multiply them. 1 times 200,000 is 200,000. Leave the points. 55,731. Next. 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 $415. So everything here is all positive. This one is only negative. So get my NPV for me. Add all the positive and subtract the negative. Oh yeah. Get my NPV for me. Add all the positives, distort the negatives. Two, 6, 2, 4. Positive, Abi. That is all. So the investment is viable because it gives us a positive word, NPV, and it should be embarked on. Any question? That is all. Any question? Any question, please? All right, so I think there are some things that you guys, this computation, this figures is wrong. This figure is wrong. So first and foremost, this 275 that you gave to me, 50,000 plus 270 plus 30,000 minus 25,000. It can't be 275. Do it for me. Yeah? 325. Thank you. Yes, 325. Now, minus 167. Minus 167. What should you be getting? 158. Thank you. Now, subtract this 34,800. So you see, 1, 2, 3, 200. I mean, now multiply by 0.839. So 103, 365. Now add up all the positive and deduct this negative. What do you get? Add up all the positive and take out the negative. What do you get? $39, 39,326. Positive. Positive. That's the answer. Am I making sense? All right. If that is fine, I'm not waiting for you to write, oh, please. All right. May 2024, question 2, SFN. So it's coming from the SFN past question. You never can tell. They can bring it for you. Okay. Now, if you look at the requirements of the question, what did they say? A, identify and comment on any errors in the investment appraisal prepared by the trainee accountant. Now, what that means is that an investment appraisal has already been done, which is what we have here. So what they want you to do is that, because you're a big dude, check it out and bring us the errors that you think that the trainee has done. Okay? So we're going to check this appraisal with our inner eye, with our experience, and check whether it is correct or not. That's just 4 marks. Okay? Then in the B part, we are told to prepare a revised calculation of the what? Net present value. So because we have been able to identify the errors, Abi, then we should be able to draft a new what? A corrected NPV, Abi. That's what we're going to do. So for number 1, let's look at the A part. Stay with me, please. Stay with me. Now, they said the following draft appraisal of a proposed investment project has been prepared. A draft, I prepared it for the finance director of Keke PLC by a trainee accountant. Now, the project is consistent with the current business operations of Keke PLC. Now, this is the appraisal. 1, 2, 3, 4. This project is actually for 4 years. Sure, you know. This 5th year is because of maybe taxation, okay, that extended. Now, please look at this thing. It's very simple. They gave us contribution. Contribution is an inflow, Abi. Money coming in. They gave you fixed cost, okay, which is what? An outflow. They gave you depreciation, which is a what? An outflow. They gave you interest payment, which is what? An outflow. Because we are experienced, let's begin to judge. I don't have any issue with contribution. For now, all is being equal. I've not read the other thing. I don't have any issue with contribution. I don't have any issue with fixed cost on a normal thing. But I have issue with depreciation. Okay, I have issues with depreciation. Because this guy removed depreciation, that is why he's getting net profits. Why? We are not supposed to have profits in NPV. We are supposed to have cash flow. I guess now, so I have an issue with that depreciation. That's the person I have an issue with. Secondly, I have an issue with interest payments. There's no way interest payment is coming to an investment appraiser question like this. Why? I've told you Your cost of capital, that's cost of capital, Abi, as taking care of what? Your interest payment. You know, cost of capital is the return that people that gave you money are expecting. Do you agree with me? It therefore means that people that gave you loan, they are expecting interest, Abi. So why would you have a return already in percentage and you are still having a return which is interest in money value? You are double counting. Does it make sense? It therefore means that on a normal day, interest payment should not even be in the limelight. It should not be here because our discount rate of 10% has captured it. Does that make sense? Okay. Now let's pause there for a while. Let's check our additional information. Let's see whether any of these figures that we have said, like contribution, is going to change. Now they said that the following information was included with the draft investment appraisal. Number one, they said the initial investment is 20,000. The junior accountant captured it very well. He said your NPV is what? 20 million, which is what? 16,457 minus 20 million. So this 20 million is the capital what? Invested. Do you agree with me? Good. So kudos. The guy tried. Now, but number two says that selling price is 120 naira per unit. They now said what? In current year term. The word in current year term means year zero. Year zero. Am I making sense? It means today, and today is year zero. Okay? They now said that the selling price, which is this 120 naira, the selling price inflation is how many percent? 5% per year. This is a specific inflation. Okay? This is a specific inflation. So it means that the selling price should be inflated by what? 5%. I do have an issue. I'm going to do it. Okay? So let's run it first. Selling price. For year 0, year 1, year 2, year 3, and year what? Year 4. The year 5 is just for tax purpose. Okay? Now, in year 0, what is our selling price? 120. That's why they said the selling price is 120 per unit, current price, which is year 0. I'm asking you, as a professional student, as a skilled student, what will your selling price be in year 1? Knowing the fact that there's an inflation of 5%. Punch for me, please. Kia. Ngozi, what are you doing for me? Give me figure. You say
105% of 120.
Exactly. 105% of 120. Thank you very much. I will tell you what you press. One what? 126. Thank you. Do 5% again on 126. What do you get? One, 3, 2. You will not take something serious. 120 times 105 because you are increasing by 5%. So you got 126 times 105 divided by 100. That's meaning of 105%. You get 132.3. So this one times 105, what do you get, sir? 6 points. Are you kidding me? Give me the total figure. Don't just give me the increment. 1, 8, 5. Next.
1459. Okay, or 145.8.
145.8. Thank you very much. Alima, when you're in your examination, I'll write everything. I'm okay with 1 decimal. I'm never supposed to use 1 decimal myself. Yes, let's approximate because this one is 120, this is 126. So 132, there'll be 139. Abi? There'll be 146. In your example, you can leave it like that. All right, so we are done with our selling price. We are getting somewhere. Where am I getting to? The first item on the NPV that the junior accountant did was contribution. And you agree with me that contribution is selling price minus variable costs. So I need to look for variable costs in this question. Take it out from my selling price so I can get my contribution. Does that make sense? Please, you people should not start. I've been in this class since. Everybody can hear me from professional. I've been teaching this since morning. Nobody complained. Can you hear me now? Please, can you hear me now?
We are hearing you, sir. We are hearing you.
I hear you.
Please. I've been teaching since morning, no network. All right, now look at the item number 2. He said, oh God Almighty. Can you just focus in my class? Look at item number 3, that's where we are. Variable cost is 17 naira per unit, current year price. So this something is at what year? Which year? Year 0. Variable cost inflation is what? 4% per year. So I'm going to say variable cost. Variable cost. Abi, it is 17 naira a year. Inflated by 4%. What do we have in year 1? Thank you. Let's just say 73. Abi, give me without dead points. I think that will make sense.
73.
What did you give to me before? 72.8. Approximately will now be 76. 76. The next one is what? 79. Please confirm.
82.
82. So help me take it out because the variable cost. Let's get our contribution.
Year 4 is 64.
Year 1, 53. These are contribution per unit. 56. Next one. 64.
64. Yeah.
60. I don't need year 0. So what's my quantity? Our quantity is 250,000, Abi, because I have to get total contribution now. Yeah. So 250,000. 400. What again? 500. 250. Yeah, multiply. This one, 3250. Are you sure our approximation have not given us problem? 250,000 times 53. 13,250. Wahala. The approximation, yeah. Oh, yeah, give me a phone. I think that will only affect variable cost, have it? It will affect selling price too. Oh, yeah, sharp. Let me punch that. Start from 120 times 105 divided by 100. 126. Okay. Times, do for variable cost. This is 132.3. Okay. Times 105 divided by 100. This is 138.9. Okay, 138.9. Okay, times 105 divided by 100. That's 145.8.
145.9.
145.9. Yeah, do for 70, sharp. 70 times 104 divided by 100. 72.8. So let's go 72.8. Times 104 divided by 100. 75.7. 78.7. 81. Okay, 81. Okay, thank you. So give me the difference now, the contribution per unit. First one is what? 63.2. Okay, 53. Go ahead. Next one. I don't need this one. We are not making any money here, 0.
56.6.
56.6. Thank you. Next. 61.4. Year 3, uncle.
60.2.
60.2. Thank you. But help you multiply now. We should get good figures. This will be our contribution.
13.3, yes. 22,640.
42.
No, 22.
Okay. Go ahead.
30.100.
Okay, finally.
15,350.
15,350. Thank you very much. Now, if you check what we have computed here as contribution, you will now go and compare it with what the guy calculated as his own contribution, Abi. From our statement, you know, the question said that we should spot out the errors and comments. So, the guy only got for year 1. For year 2 to year 4, he failed it. So let's write your comments. If you want to write, I can tell you what you can write. If you don't want to write, let's move ahead. Comment 1. Inflation is wrongly applied, or inflation was wrongly applied. I will not come back to start writing it. That's one of the things that we have observed now. Inflation was wrongly applied to selling price and variable costs. Inflation was wrongly applied to selling price and variable costs. In calculating contribution, full stop. In calculating contribution, inflation was wrongly applied to selling price and variable costs. In calculating contribution, full stop. Only year 1 contribution is correct. Only year 1 contribution is correct. The rest are rubbish. Are we good to go? The rest are wrong. That's what I mean. The rest are rubbish. They are wrong. Okay. So we are done with contribution part, Abi. Makes sense. All right, now let's continue. So that contribution, we are done with it. So let's move to item number 4, which is fixed cost, fixed overhead. And it marries with this fixed cost that we have in this thing that this guy did. Abi? Now, I said on a normal day, I don't have issues with fixed cost, Abi. I don't have issues with fixed cost. But let's check the additional information on fixed cost and see what's up. Now, they said that fixed overhead cost is 5 million naira per year, current year. What do you mean of current year? Year 0. Fixed cost inflation is how many percent? 6% per year. So let's do for fixed cost. B. Fixed cost. How much is fixed cost? 5 million naira per year. So we're going to have here 0, 1, 2, 3, and 4. So here we have what? 5 million, Abi. And what's the inflation rate on fixed cost? 6%. So what will year 1 be? Inflate 5 million by 6%. What will year 1 be? That's 5 million times 106.
5.3.
5 million. 5,300,000. It cannot be 530 million. 530 million. You divide by 100. 5,300,000, Abi. Oh, yeah, increase it by in year 2, 6% again.
5,618.
5,618. Year 3. Year 3. Year 3, please. Increase it by 6%. 5,9.
55,080.
Help me with the last guy.
6,312 2,385.
385.
Yes, 385.
All right, so this is what the fixed cost should be. Let's check what the guy did first. 5.3 correct, Abi? From year one. 5618 correct, Abi? 5955 correct, Abi? 6312 correct, Abi? Yes, no? No, they rounded it up. You understand? They forget that it's in thousands now. So 6312 correct. So let's clap for this guy. He tried for the fees cost. Abi, he got the figure. Which one is 080 again? 5955080. Okay, 080, no wahala. It doesn't change anything. Okay, so this guy got the figures under the fees cost. But, I mean, they say it's better, Abi. No wahala. Look at this number 5. We were told that 2 million per year of the fees cost are development costs. I repeat, 2 million of the fees costs are development costs per year that have already been incurred and are being recovered by an annual charges to the project. So inside the fees cost, we have 2 million naira. And that 2 million naira belongs to what? Development cost, which we have spent money on. But the thing is that we are recovering it. That means we are getting it back from our profits or from our income that we make from the what investment. The idea is that this particular additional information relates to relevant costing in investment appraisal. Any money that you have incurred in the past will not affect the project. It will therefore be seen as what? A sunk cost. So therefore, when we have clapped for the guy that he has done well, we will now do what? Withdraw our clapping for he has failed. Now, what he was supposed to do was to say, this 5 million, Abi, minus what? 2 million development cost. Because that 2 million is a sunk cost. You have incurred it before the project started. So it doesn't really affect the project. You have incurred it, it doesn't change anything. Okay? So we are supposed to have what? 3 million. Is this 3 million we are supposed to be what? Inflating by how many percent? 6%. So this guy has fucked up. So point number 2 to note, if you are writing them, this cost was correctly inflated. Are you writing? This cost was correctly inflated. Fixed cost was correctly inflated. Are we there? Full stop. However, 2 million naira development costs. However, 2 million naira development costs. However, 2 million naira development costs included in fees cost. Included in fees cost before inflation. Included in fees cost before inflation is a sunk cost and not relevant. Is a sunk cost and not relevant. Am I making sense? Thank you. Is that clear? So, what do you think our figure should be for fees cost? Our figure for fees cost should now be what? This 3 million will now be at year 0, Abi? 3 million. So get the figure for year 1 for me. Year 1, do 3 million times 6, inflated by 6%, 106. 3180. Sunk, S-U-N-K, is a past cost. Let me spell it. Sunk. It's a sunk cost. That means it's a past cost. Inflate your 3180 by 6%. 337.
337 T800.
Do it again by 6.
357 3573 048.
048. Do it again for me, yeah?
3787 431.
3787, Abi.
Yes, 431.
So this is what our fixed cost is supposed to be. So how many points have we spotted now? Only 2. And the mark is 4 marks. So you need to get at least 4 marks, 4 points as much as possible. Let's check whether we still have some things anyways. All right, let's go further. Investment financing is by a 20 million loan at a fixed. Please stop writing on my screen, please. I beg of you. Use God, beg. Let's go again. Investment financing is by a 20 million naira loan, Abi, at a fixed interest rate of what? 10% per year. Yes, we finance the business with what? 20 million. Abi, I get it now. But this 20 million was a loan. We took it from what? From a bank, for example. And we are going to pay the bank how many percent? Now, who is writing on my screen? Check your phone. And we are going to pay the bank how many percent? 10% interest per year. Now, if you look at this 10% interest, that was what this junior accountant used to discount. Is it correct or wrong? Is it correct or wrong? Why is it wrong? You are getting everything wrong. You are getting everything wrong. The 20 million that is our initial outlay, Abi, I'm not talking about working capital here. That was the money that you used to start the investment, not working capital. Now, that 20 million was a loan. And that loan, we are paying interest of it of 10%. Now, the junior accountant just used the 10%, which was the interest on the loan, as his discounting factor. As a financial expert, is that 10% correct to be used as a discount factor? We are still coming there. I like that. That interest is already out of it already. That interest payment is out of it. The question is, this 10%, is it correct to be used or is it wrong? It's wrong. It's not correct. Why is it not correct? Okay, so what's your mind? He's using it to get the present value. That's what the question is saying. That discount at 10% is your discount rate, which you are using to get your PV. So we need to know, is it wrong or is it right? Online, talk to me.
Can I say something?
Definitely, you can.
Yeah, I think, I'm not sure, but I think it is not right for him to have used that as the discounting factor, because that 10% is supposed to be the interest on the money. So I don't think that's what we should use to calculate the net present value.
Do you support what he said? The 10% is that is their expected return from what? From the loan. His bank that gave them loan, no? So they are paying the 10% back to the bank. No, now look at, they say it's a loan now. They said it's a loan. Investment financing is by 20 million loan. It's not like they have the money with them. It's a loan. So let's analyze what this lady said. Let's analyze.
Oh, sir,
yes.
sir, and looking at the question like further, they said something about the real weighted average cost of capital is
okay
7% per year,
okay
and general inflation is expected to be 4.7. So I guess that should be what we use.
Okay, let me hide that part. What do you think now? I think I did not see that part. What did you think?
I still think we shouldn't use 10% anyway.
We shouldn't use 10%. Is it the same person that said we should use, that said we should not use that? Yes.
No, what I said before was we should not use, and I explained why we should not.
Okay, I'm coming to that. Do you have any other suggestion? You want to say something? You think the junior accountant is right using the 10%? Okay. So after my explanation, you will tell me the answer. Okay. So, cost of capital is the return that the providers of capital are expecting from an investment. And we said that we are providers of equity, Abi, and we are providers of what? Debt. Isn't it? Now, this debt is the 10%, which is the loan. This equity is unknown. They didn't tell us. Isn't it? So this guy used 10% rather than he used 10% of the what? Of the debt, Abi, because that was what was available. Now, somebody said that the real weighted average cost of capital is 7%. What do you mean as a weighted average cost of capital of 7%? This is the cost of capital that has factored in both equity and debt. So all things being equal, your work should be what should be used to appraise an investment. Because if you use 10%, it simply means that you're only trying to get back 10%. Yes or no? If you use 10%, it simply means that you're only planning to get back what? 10%. So if you get back 10% and you use that 10% to pay your loan providers, what goes to your rich shareholders? Are you working for your bank? Am I making sense now? That is why we are making use of our work. This our work may look small in terms of percentage, 7, but it is higher than your 10. Because it is the average of both equity and what? And debt. Average. So when we use our work, it therefore means that we are compensating not just who? The debt providers, we're also compensating who? The equity shareholders. I don't know if I'm making sense here. It therefore means that this guy has messed up. He has messed up to use our cost of debt as what? As our discount factor. He should have used our what? Our work as our discount factor. So step number 3, let's write. Yeah? Assuming there was no work, and the question will now tell us that the company is purely debt finance. It's even that there's no shareholder, everything is debt. Then we can use our 10%. I get it now, but not when there is work. You will not be using 10%, say it is for debt. No. Am I making sense now? Not true, Abby. That's why. The 10% interest or the 10% loan interest. The 10% loan interest used in discounting the project is wrong. The 10% loan interest used in discounting the project is totally wrong. Full stop. The average cost of capital after considering inflation should be used instead. The average cost of capital after considering inflation should be used instead. The average cost of capital after inflation should be used instead. Yes, should be used instead. I don't know what the average cost of capital is, but maybe to you it is 7%, but to me it is not really 7%. And I'll tell you why it is not 7% as we proceed. Shock you? You've not seen anything. You can never be sure. So we can't use 10%. So that's 3 points. That's 3 marks. We need 1 more mark more. Let's get that 4 marks. All right. So what do we have? Let's get the mark started, right? Let's go to the next guy. 7. Keke PLC can claim 25% reducing balance tax allowable depreciation. It can claim capital allowance at how many percent? 25% on reducing balance on this investment and pays taxation 1 year in arrears at the rate of what? 30% per year. Let's look at that particular statement and see whether there's anything wrong. Now, what the junior accountant did was that he came and put depreciation and used straight line for it. Look at the figures, they're all the same. Abi, why would he use straight line? When the thing is telling you reducing, it's an oversight. Even if you claim it's an oversight. Point number 2, reducing balance, okay, on net book value. I mean, reducing balance on net book value. That is what the tax authority recognizes, not your straight line accounting depreciation. So we've got to one more point, Abby. Point number 4, let's write. Straight line accounting depreciation has been used. Straight line accounting depreciation has been used. Open bracket. This is not accepted for tax purposes. This is not accepted for tax purposes. Close bracket. Instead of the reducing balance method at 25%. Instead of the reducing balance method of 25%. So it should have used the 25% reducing balance method rather than using what? Straight line method. Does that make sense? I think now we can rest, Abby. 4 marks. But let's shove them. Let's give them one more if you can see. Abby. 25% reducing balance method. Online, are you with me?
Please, quick question.
Ask me.
So are you saying that whenever we have like, I really don't know how to put the question, but whenever we have like tax to be calculated, even if the question gives us depreciation on a straight line, we have to go ahead and now calculate it or reducing balance method, even if it is silent.
You hear what she said? All right. So what I'm trying to tell you is this, and it's very simple. One is that there's a difference between depreciation and capital allowance. The difference is that depreciation belongs to who? Financial accountant. This one belongs to who? Tax authority, or tax man. All right? Now, for the purpose of capital budgeting, what do we do to depreciation? Disallow. And what do we do to capital allowance? Allow. So what it simply means is that I am disallowing this depreciation that this guy used for the purpose of creating what? Allowing what? Tax what? Depreciation, which is capital allowance. That's what I'm simply saying. Does that make sense? I am disallowing simply means I am taking out this depreciation, I'm canceling it out. Not basically on the assumption that it is on straight line. No matter the method, if whether it is general, whether it is using balance, as far as it's what depreciation, accounting depreciation, I'm taking it out. I will replace it with what? My capital allowance, which is the one that the tax authority will recognizes. Adding what back? What we have, this depreciation that we have subtracted, you add it back. Is that what you're trying to say? That if you're doing your allowable and disallowable. Yes. Okay. So in this case,
Sir,
there's no need for me to add it back. I'll just cancel it. Yes, go ahead.
How will we cancel it?
Eh?
How are we going to cancel it?
How are we canceling what? The depreciation.
They were supposed to cancel it because I was thinking maybe we'll add it back and now deduct capital allowance.
Don't worry. I will do, in the part 2, in the B, they say we should prepare. Okay, you see what I will do. It's what I will do. Don't worry about that. But the person that asked me question, did you understand where I'm coming from? There's somebody that asked the question.
Yes, sir. Yes, sir. I do. Yes, sir.
Can we go on? So I'm giving you 4 points, Abby. Okay, that makes sense. That makes sense. All right. The scrap value. The scrap value of the machinery at the end of the 4-year project is 2.5 million. Did he use it? Oh, the guy did it. Good boy. Makes sense. So there's no mistake there. Okay, at the end of the year, 4th year. Makes sense, Abby. Next, what did they say? The real weighted average cost of capital, that's just an additional information that I've said. Then the general rate of inflation is expected to be what? 4.7%. I'm going to use that when I'm doing my Fishers, Abby. Fishers. Okay, that makes sense. After going through my additional information, everything is settled. But one more thing, let's take out this guy, interest payments. Take it out. I don't need my interest payment since I'm already using weighted average. My rate has already taken charge of what? The debt, Abby? The debt. So why am I putting interest payment again? Do you get what I'm trying to say? My work is a rate that has taken care of debt and what? Equity. And what do you pay to debt holders? Interest. And now the accountant still came again over Sabi. I don't even know. He now put interest payment again. Why are you double counting? He's in training. He's a trainee accountant. Oh, I understand. He's but he tried as a trainee accountant. But where it best me is where he's a trainee accountant and he's in professional level in ICAN. That is why I'll be very angry. It wasn't stated that the trainee accountant is in the final level of ICAN. That's why I'll be very angry. If they say trainee accountant, OND, HND, BSc, MSc, I will not say anything. Yes, MS, what did they know? I'm sorry, you. But the thing is that we are more rigorous than this is more rigorous than MS. No lecturer will be taking time to explain this thing for you. I don't know about your lecturer. Okay, so what we'll do is I will take interest out. So that should be 0.5. 0.5. So let's go 0.5. Interest payment included in the appraisal. Interest payment included in the appraisal isn't relevant. Isn't relevant. Interest payment included in the appraisal isn't relevant. As this has been what? Taken care of by the discount rates. As this has been taken care of by the discount rates. That's 5 points. If I can go and chop it.
Mr. Can you come again, sir?
Yes, I will come again for your sake. Interest payments included in the appraisal isn't relevant as this has been taken care of by the discount rates. Everybody's clear with this, Abby? All right, now, so I think that's done. That's that. Let's just do the B part. That's it. We should recompute what these guys have done. That should not take us 10 minutes. Okay. So let's do the B part. This person I wrote on my screen, what did this person gain? He can clean it, but he may not know how to clean it. That's the challenge. He had more. So maybe it's a mistake. The person may not even know that he's writing on this thing. And maybe that time the person know that it was writing. Just like you put your phone in your pocket, it can mistakenly die. I know somebody that lost his job because he mistakenly sent message to his boss. It has happened twice. So the thing is that when the boss calls him, he won't see the call. The thing will not automatically send a message to the boss and say, "I will call you back." So I'll call you back. So the thing has happened twice. The boss now say, "You sending me, I will call you back." Do you know he has explained how they had to take him off the job. Yeah, because of that, yes. All right, let's go on. Let's go on. All right, let's do the big guy. The big guy says what? Prepare a revised calculation of an NPV. So let's do a revised NPV. A revised NPV. Okay, of the proposed investment project and comment on the project what acceptability, Abby. So how do we go about it? Yes, 0, Abby, 1, 2, 3, and 4. What's our outlay? Do we have outlay and scrap? We have scrap, Abby. Oh. We have outlay, Abby. Okay. Let me not start with outlay because I started with outlay in that first one, Abby. In that first one, I started with outlay. I can decide not to start with outlay. It's your choice. Okay, it's your choice. It's your choice. So what can I start with? Let me start with contribution. Okay. Let's start with contribution. So let me just change this pattern so you can see what I'm doing. I want you guys to be very flexible. So let me clean everything here and say I start with what? 1, 2, 3, and 4. You get now. So what's my contribution? You know the contribution that guy did is rubbish. The only thing I was correct is the 13,300. So let's go 13,300. 22,000 what? 640. 3,100. 15,350. Somebody wants to ask, where are you getting this figure from? We did it now. We did it here. Okay. There's no 50 here now. The tax. No, it's 3 years. Okay, the project is how many years? Okay, 4 years. So because of tax, we can make it 5th year. That's true. Oh, oh my God. Okay, let's just see down here. Let's say 1, 2, 3, 4, and 5. So let's go. 13, 3, then 22, 640. Then we have 31. So we have 15, what? 350. So dash. So these are contribution. So let's start from there. So after our contribution, fixed cost is the next thing, Abi. This guy's fixed cost is rubbish. What's our fixed cost?
Sorry, sir. Why are we not putting here 0?
I said before I started. Don't miss out on my statements. They are all meaningful. I said you can start with year 0, or you can even remove the year 0 and do year 1 to 5. But I will still come and show you how you will put in that year 0. So just be flexible. I'm the one teaching you. Anyhow at all, you will still get the answer. You get? If I put year 0 now, this will be too long. So I can hide year 0 first and do 1 to 5. So let's go on and we're going to come back to that. So what's our fixed cost? Who can tell me? Okay, 3,000. For year 1, Abi? 3,180. Thank you. I'm coming. 3,180. 3,000. 3,370. I'm coming. 3,370.8. Next. Point what? 048.0. Next. 3,700 and what? 0.431. That is 0.4. Then for the fixed cost, forget about it. Abi? Forget about depreciation, it's out, Abi. Forget about interest payment, is out, Abi. So we are now in our taxable profit. But this time we are going to call it what? Cash flow. Abi? We cannot call it profit again now. We did not put depreciation. So we'll call it taxable what? Cash flow. So give me figure. Help me. If you ask me that question, I will stone you. Whether you are adding or subtracting, you are seeing contribution, you are seeing fixed cost. What do you do? You are seeing contribution, which is an income. You are seeing fixed cost, which is an expenses. You are asking question. Give me a question. Give me figure, please. 10, 120. 19,269. 26,527. Because you manage punch calculator, will know your own. Give me figure for year 4. Is she correct? This is 15,350. Is she correct? No, let me ask. Is she correct? 11,5 what? Okay, no point in the rest, Abi. 11,563. Any question? Any question, please? Any question? Okay. So after our taxable profit, what's next thing? Tax, Abi. We don't have any other thing. There we have tax, profit before tax. You know, this profit before tax is a derived figure. You know the meaning of derived figure. We get them as answer. That's what's my derived figure. 7 minus 3 is what? 4. 4 is derived figure. So it is not really a question. It's not really a figure that was in the distance. If you have attended my class, I've been using those words over and over. Even in your XBRO class, I've used the word derived figure and over again. You can't say you went to university and you have a BSc and you don't know derived figure. It's not possible. Right. Okay, what is derived figure? Thank you. Exactly. So profit after tax is a derived figure, Abi. What again is a derived figure here? After tax cash flow is a derived figure, Abi. Those are it. So this one is our discount factor. So forget about this part. So these two are derived figures, Abi. So the only figure that we have there is scrap value and what? Taxation. Abi, because this is where we are now, taxable profits, which we are calling our taxable cash flow. So the only figure that are there is what? Taxation and what? Scrap value. So let's put in our tax. Tax is how many percent? 30%. Am I having class now? Tax at how many percent? Check the question now.
It's 30% in arrears.
Yes. Okay, so how do we get our tax? How do we do our tax?
You have to go and calculate for
How do we compute our tax?
allowance.
30% of this figure is how much? The taxes are paid in arrears, Abi. Good. So 30% of 10, 120 is what? Now, I told you that taxes are not calculated on cash flow, Abi. That taxes are calculated on what? Profit. Now, watch me. Watch me. If I am to calculate this 30%, this is my tax, at 30% on these cash flows that we have here, then I'm going to include one more line. I'll call it tax savings. This should not be a problem because we've done it in our part 1. Does that make sense now? If I have to calculate my taxes on the cash flows, I'm going to include what to call what? Tax savings. So do taxes on the cash flow. But if I have to calculate my taxes on net profit, which will require me to go and do the working somewhere else, I do not need to include what? Tax savings. So let me use this method for now. So tax at 10, 120, what do you have, please? So I'm going to put it under year 2. Person that wrote on my screen is not making me. Okay, so this is tax at 10%. 30, 30, 36. So put it in brackets. Put the tax of 19,269. We're going to pay it in year 3. 5, 7, 8, 1. Bracket is tax. All right. What about the last tax? Tax of 26,527. How much? 7,958. Because they said the tax is going to be paid in arrears. Then do the last tax, 11,563 times 30. 3, 4, 6, 9. Abi? Bracket. So now let us do our tax savings and include it there. So how do we do our tax savings? Let's do our working here, please. Okay. Who was with me when I did the part 1? We did tax savings there.
Yes, I will with you.
Who can guide me? Any professional in the house? Yes, Abi? The cost, Abi? Whatever name you are calling it. The capital allowance, Abi? And what? The tax savings, Abi? And the year due. So the tax is at 30%. So we can start from year 0. Okay? But since we are not charging tax in year 0, we can just start from year 1. Abi? Just jump 0, leave 0. Year 1. What's the figure? Cost is, how much did we invest in this thing? 20 million. I'm going to say 20,000. Hide the 0, 0, don't worry. Then our depreciation at how many percent? 25. Abi? 25% of 20,000 is what? And 25% of 20 million is what? 5 million. That goes how much? 15,000. So take this 5,000 here. Okay, this is your tax incident value, I mean. Therefore, year 2, your depreciation will be how many percent? 25 again. This is on net book value. So do 25% of 15,000. 3,750. Minus it, what do we have? 12,750. Is it 12 or 11? Punch, check. 11,250.
11,250.
Okay, take this one and put it here. Next one is what? Oh,
It's 11,250. Okay, it's 3,250.
okay, 11. Okay. Okay. 7,250. So year 3, depreciation will be what? At 25%, I mean. Oh, yeah, run it for me. That will be how much? 2,813. Abi. So that will give us how much? 2,813. Are you getting it? 8,437. All right, these are tax incident value. I mean, what you call net book value. It's the same thing. How many years is this project? 4 years. What did I tell you at the end of the year 4? Good. So now we are in the 4th year. So in the 4th year, forget about that depreciation at 25%. Are we there? How much did we sell the assets? 2,500,000. 2,500,000. So if the asset worth 8,437 and you sold it for 2,500, what does that mean? Balancing what? Is it a profit or a loss? Let's make it simple first. It's a loss, Abi. Something of 8,437. You are selling for 2,500. It's a loss. So when you make loss, what do we call it? Balancing what? Allowance. Hey, Gone, what's the difference? 5,937. So bring it here, 5,937. So we are good. So our tax savings will now be what? Do 30% of these figures here. One five. 1,125. Next one. 845. 1,781. Is it correct? Now check. When is it going to be due? They said the tax is going to be paid 1 year in arrears, Abi. So year 1 will be paid the what? Year 2 we pay the what? Year 3 we pay the what? Year 4 we pay the what? Year 5. So this is tax savings, meaning that we are saving tax. We are not incurring it. Abi, money is coming in. So let's take it to our solution. 1,500. So tax savings start from what? Year 2, Abi, 1,500. So let's go. So year 1 is dash. Start from year 2, 1,500. So it's a plus to us. 1,125, Abi. 1,125. 845. Then 1,781. Any question? Any question, please? How did I get what? Look at it now. I just solved it. Are you looking at your note when I was doing it? 30% of your capital allowance. Any question? Any question? Any question? All right. All right. I think the only thing that is scrap value, Abby, we have done our tax. So I told you that profit after tax is the right figure, Abby. Then this one is scrap value. So let's do scrap value. Scrap value. Please, golden rule. Golden rule. If you are using this method where you have tax and you have tax savings, make sure that your scrap value comes after both of them. Don't go and put scrap value up. Okay, imagine that you put scrap value up. You know this 10, 1, 250 will not be, the scrap value is at what year first? Year 4, Abby? 2,500. Imagine that this scrap value, you have put it up, you would have taxed it. Yes or no? Because it would have increased this 11,563 and you'd have what? Taxed it. Whereas when we are doing our computation here, we have adjusted for it here. We have looked at the tax here, which is our balancing allowance. So therefore, let your scrap value come after you are done with your taxes and your tax savings. Yes, guys, in this method. Yes. Does that make sense? Okay. I think that's all. 1, 2, 3, 4, 5. Give me figure. There will be 10, 120, Abby. Madam, check now. You don't have calculator. No, you are very important here to check. Give me figure for the next one. 17 what? 73. What do people know you are even doing, sir? So this is your taxable cash flow, Abby. So this minus this plus this. So you are doing everything like this. The other one is what? This second one here. 21, 871. Six, 9. Do it from beginning, do it from beginning. This one minus. So give me this one, please. I need this year 4. Six, 9, 5. So that's our after tax cash flow, Abby. What do you do again? You can tell me. Barrister, what do we do from here? You don't know if people read, I will know. If you not read, I will know. If my students read, I know. If my students do not read, me, I still know. And when you now begin to ask me what I have told you over and over and over again, it frustrates the lecturer. Discard factor. Thank you. So where the problem will come now, at what rate? If you say 10% again, I will stone you.
Said we should use 7%, but now they gave us another additional information that the general rate of inflation is expected to be. I don't know if that would affect it anyway.
All of you physically, you have failed. Yes. Somebody is answering online, and the person is making serious sense. 7, and you factor in inflation. You are the only one that got it. You all of you are just saying 7% at the whack, 7% at the whack. The 7% given to you in the question is your real, which means without inflation. But the figures we have used so far in this computation have not affected it with inflation. And what did I tell you? Money cash flow, which is the cash flow that has inflation. What will you use for it? Money what? Money cost of capital. Thank you. And some people say they are barrister. Which cost are the which All right, so let's go. So somebody was trying to say that online as well. So our discount factor, use 7% in your exam now. Your discount factor is your what? Real cost of capital, Abi, plus what? Inflation, Abi. And what did I say you're going to do? Use what formula? Fisher's formula, Abi. Oh yeah, give me the formula. What we're looking for now is our money. Wait. What we are looking for now is our money rate. So that will be what? 1 plus R, Abi. 1 plus inflation, Abi, minus 1. I gave you this formula, Abi. Good. Because we're looking for our money rate. So what is our 1? 1 plus, what is our real rate? 7%. Abi, your real work is 7%. So 7% is what? 0. What? 1 plus, which inflation are we using? 4.7. Why am I not using 6% for this overhead? Or why am I not using 4% that they gave to us in variable cost? Those are specific. So I'm going to use what? General inflation. So 4.7% is what? 0. What? 0.047. Anything you get minus 1. Money rate. Oh yeah, do this for me. Do this for me. 1.07 Abi times what? 1.047. Anything you get minus 1. Figure me. Give me the final answer. Give me the final answer. %. Thank you. I hope all of you got 12% too. Before you will see me in your dream. Eh? In your exam, use the 029, no problem. I'm using 12%. I don't know where you're getting your own from. So I'm using 12% here. So my discount factor is 12%, Abi. Oh yeah, run it for me now. For year 1, what will be my discount factor? What will be my rate? Use 1 all over 1 plus R raised to n. Our rate here will be what? 12%. While your n is the number of years you're calculating for. So do for year 1 for me. Year 1 is what? 0.89, thank you. 93. 0.7971. Just a 3 decimal. Let's leave it at yes. Remove that one. Next. Which one? Where did I write it? 0. What? Okay, yeah, 4. 0.6635. Final one. 567. Oh yeah, multiply. Let's get our present value. The first one, I mean, 90. Next. The last one is what? No one. Do it again, it's wrong. 13,956. Next one. 15,572. Next one. 4413. Are you sure this one is 957.8? 1688 times 0.567. 957. 9575. How? There has to be points now. What are you getting? The 957 point. Okay, you multiply with the full one. No wahala, no wahala. All right, so since we have our present value, Abi, please add everything together. That will give us our total PV. Add up all this one and take out the negative one. This is 903637, 13956, 15572, 4431. 4431, 957.8. $42 what? 020.2. So forget about the 0.2. Yes, you add all this positive and take out this one. You got this one, Abi? Total PV. Then the last thing is our initial outlay. So your initial outlay is that year 0 that people don't want to allow me to rest. What is the year 0? 20,000. Abi, which is 20 million. You just move it. It doesn't mean anything. So your NPV will now be what? So should we accept this project or not? Because why? It has a positive NPV. That is all. Any question?
I will not necessarily say a question.
The person's voice is low. I can't hear you.
Okay, I said, sir, I don't, I will not necessarily say it's a question, but I just want to be sure. So whenever we are treating a capital budgeting question, even if they give us inflation, depreciation in the question, we don't take account at all depreciation. Like we don't bring it, even if it has been deducted normally for them to arrive at their profit, we just totally ignore it. We don't try to add it back. The only thing we have to now do is we have to now solve for capital allowance, and then it has to come up during profit, right? I just want to be sure.
Okay. So in this question, somebody is asking a question already. All right, so let's assume that we have a project one and that will last for 3 years, okay? And let's say this is the contribution. What's the contribution? Let's say here is 10,000. Let's say here is what? 12,000, Abi. And let's say here is what? 15,000. And then we have fixed cost, Abi. Let's say here is 1,000. Let's say here is 2,000. And let's say here is what? 3,000. Then there was depreciation here. And let's say the depreciation here is also 1,000. Let's make it simple. And here is 2,000. And here is what? Here is what? 3,000. So give me figures for this, please. All these things are minus, yeah? So this is 8,000. This is 8,000. Next one is what? 8, Abi. Next one is what? Are you sure? 9 plus 6, okay. So this will not be like our profit, Abi. I'm just trying to paint the same scenario that I have here. You get? I just move this guy out. Now, what she's asking after is how do we treat depreciation? You know, this idea of we are going to add it back, Abi, that is what is confusing people. How do we add back the depreciation? How do we do this depreciation? It depends on where you are starting from. When I was providing my own solution, I started from contribution, Abi. When I started from contribution in my own solution, there was no need for me treating what? Depreciation again. Because I'm starting afresh, Abi. But assuming I want to show skills, I don't want to start from contribution. Am I making sense now? I want to start from what? Profits. I'm solving my NPV now, but I'm starting from profits year 1, year 2, year 3. Common sense has told me that I cannot use profit for NPV, Abi. What is my profit here is what? 8,000, Abi. Here is what? 8,000, Abi. Here is what? 9,000. The first thing that we need to do is to what? Convert the profit to cash flow. What do? You add back depreciation. So this is what is confusing you. Like, why are we not adding back depreciation? It depends on where you are starting from. That is why you are in my class. So because you are starting from profit, I will come and do depreciation. What is my depreciation? 1,000. Abi? 2,000. Abi? And what? 3,000. So this will not be. Abi? So what will I do? Add it now for me. Will now get what? 9,000. 10,000, 12,000. Is it not the same thing as when I pick, look at these two and remove this one? 10 minus 1, 12 minus 2, 15 minus 3. What are we talking about, ladies and gentlemen? Skills. So stop, don't add that. We're supposed to add back depreciation. No, it depends on where you are coming from. But just understand that we don't need depreciation. We don't need it. Because the moment depreciation is there, you are getting profits. But MPV is saying, I don't compute using profit. I compute using what? Cash flow. So when I was doing my own solution, because I am starting from scratch, which is contribution, I just dumped depreciation as if it never existed. I don't know if I answered that lady's question. Are we together? Yeah. We are together. Madam, you asked me a question. Are we together?
Yes, sir. I said yes, I understand.
Can you hear me? Can you hear you?
I said yes, sir. Yes, sir. I understand now. Thank you.
So leave depreciation is then what you now need is capital allowance. Okay, what you now need is your capital allowance, which you will now be using when you're calculating your taxation. So that was why when we were computing for our tax, okay, we now calculated our capital allowance, which is what we did here. So that is it. We don't need depreciation. So it depends on where you are starting from. I can start from anywhere, but how good I am to adjust, that's what it means. Anything again? I think I'm done. I've tried. Ladies and gentlemen, I remain Dr. President. Thank you for your time. Thank you for staying with me.